Welcome to The Explainer. Today, we're throwing on our expert investment analyst hats and running a really fascinating company through what I like to call the Guru Gauntlet. We're going to stress test Tompkins Financial, that's ticker symbol TMP, using some of the world's absolute most legendary investment frameworks. We're talking Warren Buffett, Peter Lynch, and Benjamin Graham. And then we're going to ground the whole thing with some hardcore, modern, discounted cash flow modeling. Learning how to apply these specific frameworks, it's going to seriously sharpen your own analytical tools and help you spot true value in literally any market. So get ready, because this is going to be incredibly insightful.
So here's our roadmap for today. We'll start with a quick snapshot and the Buffett lens, then move right into the Peter Lynch lens, followed by the Benjamin Graham lens. After that, we'll crunch some numbers with DCF and other valuations and wrap it all up with our synthesis and final verdict. Let's get right into it.
Okay, let's dive into this with Section 1, Snapshot and the Buffett Lens.
First things first, let's just ground ourselves with some basic facts. Tompkins Financial is currently trading at $91.51 per share. They're a regional financial holding company operating primarily up in New York, and they've got some serious scale. Total assets are sitting at nearly $8.7 billion. Now, that's a really solid footprint, right? But as we know, size alone doesn't automatically make an investment a home run.
Which brings us to the million-dollar, or, maybe billion-dollar question. Would Warren Buffett actually buy this bank? To figure out if the Oracle of Omaha would allocate capital here, we have to apply his specific qualitative and quantitative requirements. Remember, Buffett doesn't just buy banking assets. He buys highly protected, wildly efficient compounding machines. Because before committing a single dollar, Buffett wants to see an economic moat and consistent earnings. Essentially, he's looking for a distinct, built-in advantage that protects long-term profits from competitors, paired with a rock-solid track record of historical profitability through all kinds of economic weather. Now, honest management and manageable debt are crucial too, but honestly, it all starts with that moat and the earnings.
Well, the data here paints an absolutely brilliant picture. Tompkins Financial has been profitable every single year since at least 1942. Just think about that for a second. We're talking about surviving World War II, the dot-com bust, the 2008 Great Financial Crisis, and the recent pandemic, and they didn't post a single unprofitable year. Now, that is the literal definition of an economic moat and supreme earnings consistency.
But Buffett, he also demands a high return on equity, or ROE. And looking at the end of 2025, Tompkins posted a seriously impressive ROE of 17.2%. If you compare that to your standard banking benchmark, which hovers right around 10%, it is crystal clear they're utilizing shareholder equity with exceptional efficiency. So between that historic moat and this stellar ROE, Tompkins easily clears Buffett's initial hurdles.
All right, moving right along to Section 2, the Peter Lynch lens.
The very first step in Peter Lynch's playbook is categorization. We have to ask, how would Lynch categorize TMP? Is it a fast grower, a slow grower, a cyclical, a stalwart? Well, given their long, steady history in regional banking, they'd typically be slotted right into that stalwart category. Those large established companies that give you steady growth and downside protection. But here's the kicker. Their recent earnings jumped over 27%, which actually adds a really exciting fast grower flavor to the whole mix.
So, to balance their valuation against that recent growth spurt, Lynch relies heavily on the PEG ratio. You calculate this by taking the price-to-earnings ratio and dividing it by the earnings growth rate. In Lynch's world, a PEG ratio of exactly 1.0 means a stock is fairly valued. But anything significantly below 1.0, that suggests a stock is deeply undervalued relative to its growth potential.
And when we crunch the numbers for Tompkins, things get really exciting. Taking their current PE of roughly 13.7 and dividing it by their recent trailing earnings growth of 27.6%, we arrive at a PEG ratio of exactly 0.50. For Peter Lynch, finding a highly profitable, stable stalwart that is trading at basically half its growth rate, that is a massive flashing buy signal for sure.
Okay, let's shift gears to Section 3, the Benjamin Graham lens.
Graham, the father of value investing, built a very strict checklist for what he called the defensive investor. And Tompkins honestly passes with flying colors. Adequate size? Yep, well over $8 billion in assets. Earning stability? We already know they've been solid since 1942. A strong dividend record? They pay out a really healthy 3.25% yield. Moderate PE? Yes, sitting nicely at 13.7 times. And a moderate price to book? Absolutely. Actually, if we take their $946.7 million in total equity and divide it by their 14.33 million shares, we derive a super solid book value per share of $66.06. That gives us a PB ratio of just 1.38.
Now, let's apply Graham's famous intrinsic value formula. The math here is legendary. He
He proposed that intrinsic value equals the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. So let's take Tompkins' 2025 GAAP EPS of $11.24 and plug in our derived book value of $66.06.
And guys, the math gives us a payoff that is just hard to ignore. Graham's formula yields an intrinsic value of $129.25 per share. With the stock currently sitting around $91.50, Graham's uncompromising formula is showing us a massive 29% margin of safety. For a deep value investor, this is incredibly compelling. It really just shows why having a strict mathematical framework can help you spot opportunities the broader market might completely miss.
All right, let's bring it into the modern era with Section 4, DCF and other valuations.
So we built a discounted cash flow, or DCF model, based on the free cash flow generation implied by the source data. Basically, a DCF forecasts future cash flows and discounts them back to what they're worth today. For our assumptions, we used a standard weighted average cost of capital, or WACC, of 10% to discount the cash and a highly conservative terminal growth rate of just 2% for the long term. By running a sensitivity table on these assumptions, we can easily see how tweaking them changes the value. But let's focus on our base case.
Under those standard, highly conservative assumptions, our base case DCF calculates a fair value of $132.47 per share. Notice how beautifully that aligns with Graham's math. It highlights that at the current stock price, you are basically buying into this bank at a near 40% discount to its pure cash-generating potential. But hey, as objective analysts, we've got to look at all angles here. When we run a comparable company analysis looking at valuation multiples against peers, a bearish signal does pop up. Tompkins is trading at a PE of 13.7x, which is actually a premium compared to the regional banking peer average of 10.9x. If we value them strictly at that peer average, their implied value drops down to around $122. So the market is currently charging a slight premium for their stability relative to other regional banks.
So what does this all mean? Let's get into Section 5, Synthesis and Final Verdict.
Here is our grand synthesis. Just look at how tightly clustered these valuations are. Benjamin Graham's formula suggests $129. Our discounted cash flow model points to $132. And even when we apply that stricter peer-implied multiple, we still get $122. Across completely different methodologies, the fair value is consistently anchored firmly in the $120 to $130 range.
Now, before making the final call, we absolutely have to objectively weigh the complete picture. On the pro side, you've got an incredible 17.2% ROE, strong recent margin support, and a highly reliable 3.25% dividend that literally pays you while you wait. On the flip side, critics will point out a longer-term 5-year historic earnings decline trend prior to this recent burst. Plus, as we saw, you are paying a slight PSP premium compared to lesser quality peers.
But taking all of this into account, our synthesized final verdict, based on these legendary guru frameworks, is a clear buy. With a blended fair value sitting comfortably right around $125, the margin of safety is simply too wide to ignore at current levels. For value and growth investors alike, any price below a $120 trigger represents a fantastic entry point into a historically resilient institution.
I'm going to leave you with this final thought. We noted earlier that the stock trades at a slight premium to its current peers. But ask yourself, does a minor PE premium really matter if you are buying an economic moat that has proven itself every single year since 1942? It's a fascinating question of price versus permanent resilience. Thank you so much for joining me on this explainer, and I really hope this deep dive into Tompkins Financial has sharpened your own analytical tools.